Today we are going to do a couple things. First thing I have to do, which is quite embarrassing, is I have to correct something I did wrong in the Chapter 4 handout. It's triply embarrassing because it's under US GAAP. So, if I'd made it under international standards, it might be, but I gotta, it's not a big thing, I don't think, but anyway, correct Chapter 4 handout on inventory. Then we're going to start on the Chapter 4 textbook problems. And we're going to do a Chapter 4 and 5 multiple choice review. And then I'm going to send out the exams by tomorrow. They'll be due by Friday the 30th. I might get these out today. I'm trying to get them out tonight, but certainly by tomorrow I'll have the exams out. Okay, questions on that? Do me a favor, you could pull out your that Chapter 4 handout on inventory. And it looks like this. And if you go down to near the end, not that far, down to here, the net realizable value, I told you that was for the international standards. This is what they use as the market. We actually do the same thing for Gaap now. So we don't do any of this down here, which is a good thing. I think part of the reason why, it was such a problem was that it was too complex. But anyway, so all of these would be the 240. There is no ceiling or floor anymore. It's just the net realizable value is it. And this was the same. This is the same as the international standards. So the international standards, when it comes to the lower of cost or market or what they would call the net realizable value, they're identical. So there is none of that ceiling floor stuff anymore. They're all net realizable value. And if they do say market for the Gaap ones, it's still net realizable value. Now they still can't write anything back up, but the lower of cost or market or lower of cost and net realizable value are the same. So this is the only relevant number we need when it comes to writing it down. So that's the lower of cost or market if the market is lower. And because of that, the replacement cost doesn't come into play. You don't need it because there is no ceiling or floor for it to be between. Makes things a lot easier, and which is probably why they went to the same as the Europeans, not the Europeans, international, they should say. Okay, I apologize for that. That's a gap. I should have known that they had changed that. All right, what we're going to look at today is The textbook problems. And by the way, maybe you guys can check and see if it's the same for you guys, but do you guys have this in yours? That all the problems are number one?
No, it doesn't look like it for me.
Because all of these problems are they're all number one. So here's number one. I think that's actually problem 15. Here's problem one, that's 16, 17, 18. That's just mine?
Mine isn't like that, no.
Oh, wow. I wonder why. No, I mean, I'm glad yours isn't. Well, in that case, I can start assigning problems just out of the textbook then. I mean, I can figure out which ones they are, but they show all of them as one, number one. Okay, well, that'll be my problem. Okay. So what we're going to do is go through the lower cost or market or lower cost net realizable value, which this is. See that? Okay, lower cost or market net realizable value. So this is, I think before I told you this is for the international standards, this is actually for both standards. Okay. So we have these products. These are in different product lines, which may not sound very important, but if they're all in the same product line, we could combine them, but because they're in different product lines, we can't. Okay, and so here's the cost. This is what they paid for them. Here's the selling price. And we still have to find the selling cost. So this is 5% of the selling price on each product. So this is so you multiply each of those by 0.05. Or 7. Okay, so these are the selling. So the net realizable value will be the selling price minus the selling cost. Maybe there's like a commission or something. What gives a net realizable value of okay, so which is the lowest? The cost or the net realizable value? So the first one is the cost, right? It's the lower. 'Kay. Okay, so for these three items, just tag a row on the bottom. Hey, look at that, it worked. Okay, so the cost was $390. $339. Okay, so this would be our loss. So which would so determine that what the report on the inventory. Okay, so we'll have a no, determine what amounts they should report on their inventory. So it'd be 339. Okay, so this is what they should report it on there. Okay, and so my do my difference in credits. Okay, so we have to write down the Inventory. December 31st. Okay, so we're gonna have a inventory write down expense, and expenses are gonna go up with debits, so it's gonna be a debit. For how much? How much are we gonna write it down by? Anyone? So this is what we have in our books at.
Would it be 51?
Yeah, it's a question I don't really. Yeah, 39, 40, yeah, so it would be 51. Yeah, so it'd be 390 minus. Kind of like a loss. I'm going to put expense here because it's. They have them here. Okay, so this is. Expense. They tell us to use the inventory valuation allowance. So just to kind of show you how this would be shown on the balance sheet, or it depends, they might be shown a few different ways. But basically on the balance sheet, it would kind of look like this if they included all of this. It's a the inventory cost 390, they would have the inventory valuation allowance. Oops. So if they put in real life, like a lot of larger companies would probably just use that. But if they were to kind of spell it out, it would look like this. Inventory costs, inventory valuation allowance. And you'll notice that assets are generally debits, right? Inventory, if you have any inventory on hand, is a debit. You can't have negative inventory, but so if you have any inventory on hand, it's a debit. But you'll notice that when we did this here, this is a contra asset account. It's a debited. Check that credited. Question there? Okay. Okay. Problem 16 is the same thing, except that it's going to be the reversal of the write down. So here we wrote it down. And the question is, well, what happens if the market rebounds. Okay, so we kind of go through this whole thing again. Okay, so selling costs are at let's see what numbers we got up here. $31, $33.76. Yep, okay. All right, so this is what we're carrying them at. And it looks like product 101 went up to 180. And that would be $9. 5% would be the cost. $60 times 0.05 is $8, I think. So would that be 152? Okay, so lower of cost or market. Yeah. Carry amounts, and then we have these in the books. So that would be oops. We're not comparing that. Okay, so lower of cost or market, this would be cost 130 and valuable value, and so that would be 130. $160 versus 152, so this would be 152. $100 versus 100. Okay, so we have recovered some of our loss up here. Determine what amount they should have them in front of the inventory at the balance sheet date. Well, this is the lower of cost or net realizable value, so I'm gonna be lazy and copy this down. Now notice they still have it on their books at where did it lose? 339. So how much do we have to reverse out? Now, we can't go over the 390, and we're not going to. You can't go over 390 because if even if the market was all way above that, the lower cost of market would just be cost. So we're still down a little bit, but not near what we were before. So what's going to be the journal entry down here? I'll tell you what, I'll put in the accounts. There it is right here. Reversal of inventory write-down expense. This is going to be reducing our expense. Okay, so we're going to reverse out some of this loss. Now the question is, how much? This time we'll know what it is when you say it. How much of the loss we have to reverse out?
Is it 43?
Yep. Yeah, because you'll notice that up here that this is the loss, the new loss, let's say. Is $8. The difference between those two. But we already have this written down for 51, so we have to reverse out. Right. I'm sure there's a better way to do this. So the old loss was 51, the new loss is 8. If you ever have wording it, jump in. So we had to reverse out 43 of it. So this would come back as a reversal write-down expense. This would be sort of like a gain. And that allowance account would now be down to 8. It looked like this. This is what the allowance account. This is what it would look like on the balance sheet. The O there. $382. How would it? 14. How would the answers above differ if we choose US GAAP? US GAAP does not allow for reversal. US GAAP said, okay, well, you'll just have to wait until you sell it and then realize the gain. Whenever you sell these, whatever they are, whenever you sell them, that then you'll recoup that, the money. And again, the lower of cost or market is now exactly the same for GAAP and for international standards, IFRS. The market is exactly the same. And if you're wondering why they do that, it's sort of a conservative approach, and I don't mean this politically. It's a conservative approach that that you never want to overstate your income, your revenues, or your assets. And so by having something on the books that is on there for more money than you can actually sell it for, they felt like, okay, we got to make these more realistic, and that we're not going to be able to sell this for whatever it is. You know, if you can't sell it for what you put into it, you'd be overstating your assets. Okay. So this is problem 18 in the book. I expanded on it a little bit, but okay. So Stevens acquires a 1-year-old building at a cost of $500,000 at the beginning of year 2. Okay, so there's kind of a funny wording on it. Don't get thrown by that. So we're starting on, so year 2 is our year 1. The building has an estimated useful life of 50 years. However, based on blah, 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 the carpeting will need to be replaced in 5 years. The roof will need to be replaced in 15 years. Oops. And that's the heating and air conditioning system. Will need to be replaced in 10 years. Okay, so carpeting is 10, roof's 15. Okay, blah, 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 blah. Okay, IFRS depreciation, we split it up for IFRS. So probably the easiest way to do this is just get all the individual stuff, and then whatever's left over will be in the building. Okay, so that should be an H. Heating. I don't know what the V stands for. Heating V something, and then AC. I don't know what the V stands for. Ventilation, maybe. All right. Anyway, oops, okay, and last and certainly not least is the building. Which has a value of 500,000 minus all this. $25. 445. May want to check that. 60. Yeah, I think that's it. That's right. Okay. So, divide this by the number of years. Carpeting is 5 years. 2,000 a year. Years. Oops. By the way, what you get on your test will be similar to what these are. Similar to the textbook problem. Heating air conditioning system is for 10 years. 3,000. And the building is for. We're going 50 years. 50 years. $8,900. And again, this is year 2 because they bought it in year 2. It's not usually the way they show those, but it's at 14,900. Gap depreciation would just be the building. Now, you might be wondering, you say, okay, well, why doesn't Gap depreciate all this other stuff? Why are they depreciating the stuff and Gap isn't? US standards aren't. And it comes down to basically what we would term maintenance. you know, if you make those expenditures for something to maintain that asset, we consider the whole building to be one asset. Just like on a car, when you replace the tires, you know, okay, you get a car, it's new, in a couple of years, replace the tires, the car's gonna last a lot longer, but you replace the tires, you just record a maintenance expense. You know, the car's not any better than it was before, but you're just maintaining it. That's our view of the US, you know, Gaap view, I should say, maybe not our, but that's the Gaap view is, okay, well, you're just maintaining it. You know, okay, you need carpets, okay, that's fine, and every 5 years you put new carpet in, maintenance expense. Put a new heating system in, just maintenance expense and so on. So it has to do with the way that Gaap views maintenance, maintaining an asset, rather than each thing as an individual asset that we have to look at. In the end, I mean, the costs are gonna be the same, right? I mean, all we're talking about is how we allocate those costs out. The actual buying of the building, using of the building, that hasn't changed at all. It's just kind of how we allocate that out. Okay, so the IFRS depreciation. So IFRS depreciation rules will be, well, I think I told you this before. The depreciation is always the same, dead, kind of morbid, but works. Depreciation expense. And accumulated depreciation. So international standard would be 14,900. The Gaap standard would be that. No, bad teacher, bad teacher. So under the Gaap depreciation rules, we would just take the whole building, it's gonna last for 50 years. Yeah, we're gonna have to do some maintenance, you know, in 5 years, 10 years, 15 years, whatever. When we make those, you know, when we make those maintenance costs, we will simply expense them. They're simply part of maintaining our asset, which is the building. And again, you know, we're really just talking about how we split it up over the years. Okay, making a consolidating entry for so making a consolidating entry for the US rules, if this was a US subsidiary. If the Stevenson Corporation was a subsidiary of a US company, what would be the consolidated adjusting entry? Now, there's two ways to do this. You could just take the difference between those two, right, and reverse out the amount. You could also take it off completely and put the correct one on. You know, or I should say the correct one, the US Gaap one on. And by the way, that's something I would encourage you to do when you get into accounting. Make it easy. You know, trying to think about what would change, and you know, and this one's not too bad, but a lot of times you get 3 or 4 things happening. If you run into a journal entry that was made wrong, and you will, and they say, okay, what's the correcting entry? I would say, instead of putting the correcting entry on, take the old wrong one off and put the new corrected one on. Now, we're not really correcting here, we're just simply, adapting it to Gaap standards. But, the idea is the same though, is that remove the old one, put the one you want on, in its entirety. It's usually easier than trying to figure out, okay, how much we take out of this account, how much we take out of that account, let's switch it around. And then that's if you guys go into auditing, trying to explain a correcting entry is going to drive you nuts. So when you come up saying, okay, this is what we need, this is what you guys need to do, it's easy just to say, take the old one off that wasn't right and put the new one on that is right. That's usually an easier explanation and an easier sell than trying to explain an adjusting entry. Okay. So, if you, I would just probably take off the so reverse the IFRS. So we would put and just put it on the books as oops. And when we did the second one, we did before. Oops. And if you're doing auditing, say reverse the error, enter the corrected entry or something along those lines. It's usually easier than trying to unfigure, and especially too, a lot of times when you're looking at things that are wrong, for some whatever reason it makes it harder because you're used to having the correct journal entries, and so trying to make a correction is a lot of times difficult. Okay, number 19, you know what? I think we'll take a break. Number 19 takes a while. Yeah, I think let's take a break here. Get back at say what 7:02. Yeah, number 19 is a yeah, it's gonna be a little involved. Depreciation ones can kind of drag out. And just so you know, you're not going to be responsible for any other topics that we covered for this chapter. We literally could spend a whole semester on first day on chapters 4 and 5 easily. But there's other things we need to talk about. So anyways, there are some things in there, the things in there on pensions, and there's things on there on converting incomes and all this kind of stuff, reconciliations. Don't worry about that. Only the stuff that we, only the topics that we cover are gonna be on the test. And I don't even know if you guys have had things like pensions and that yet. Have you guys had that in your the intermediate accounting classes or no?
I think we briefly covered them in one of them.
Okay, all right. I guess maybe we could have gone through them, but they're not that different, to be honest with you. They're fairly similar. So anyway, all right. So we'll be back at 7:02 and we will start this up again. Oh, wait a minute. Okay, sorry about that. All right, impairment of assets. It's a really big thing for Gaap, and it's a really big thing for IFRS. And it has to do with when an asset is not worth what you have it on the books for. Kind of like the inventory one, but generally we're talking long-term things. And a lot of times you'll have huge write-offs. It can be huge. I remember the place made this investment of $900 million in this store brand, and literally like within 3 years, it was written down to like 200 million. So they literally had written off $700 million. And that's what you're kind of looking at is what is it worth, and you don't want to overstate your assets. So that's what they're talking about here. Okay. So 19. Oops. Year one has a cost of $100,000 estimated life. 10 years, zero salvage value. That's nice. Makes it easy. Straight line. Hey, even more easiness coming our way. So company operates in year 4. Quick gathers the following information for this piece of equipment in 4. Okay. All right. So the cash flows, the undiscounted cash flows. I'm gonna move this over. This is what you use for Gaap to see if it's impaired. The undiscounted cash flows. The expected future value, the present value of the cash flows, the discounted cash flows. This is for IFRS to see if it's impaired. And net selling price used in the market. This is only used for IFRS. Man, I'll say IFRS. Okay. Now this isn't exactly true. If you do find something is impaired, then you start looking at the fair value for Gaap. So this is just to determine whether it's impaired or not. So this is only for the impairment, you use the undiscounted cash flow. Once you find something is impaired, then you start looking at trying to find what the value should be on it. But so this undiscounted cash flows are only to see if it's impaired. Okay. Well, we have to see what it's worth. So the cost was $100,000. Divided by 10 years. Okay. So We would have on the books of equipment. $100,000. At the end of 4 years, we would have accumulated depreciation. And so you'd have a book value or a carry value of. Okay. Now it says here, technology, technology innovations take place in the industry in which the company operates in year 4. Okay, so the rules on this are that if something takes place that would indicate that there's that the asset's impaired, you must do a reevaluation. Also, periodically, again, very vague, international standard wording, that periodically you have to take a look at it. What's periodically? Is it every 2 years, 3 years, 5 years? What is it? They leave that to judgment. US standards, they would tell you every 3 years, every 5 years, whatever it is. International standards, they leave it a little more open. Okay, so does the company have to impairment test? Yes, because something has changed. There's 2 N's in innovation. So whatever it is, maybe it's some improvement in computerization or whatever. But if you do come across that there's 2 N's innovation, then you must take a look at it. Okay, asset impaired on IFRS rules. Carry value is 60,000. Versus the discounted cash flows, 52,000. Yes. US standards use the undiscounted. Come on. Oh man, what is this? Use undiscounted cash flow. So this is let me color coordinate these. So this is the Gaap. And this is the IFRS. So they're both impaired. The undiscounted cash flows are for Gaap. The discounted cash flows are for IFRS. Now, once it's impaired, you have to come up with the carry value. And this is where, you know, in the US standards, they say, okay, it's undiscounted cash flows, but when you start looking at the value, there's actually a few more hoops to jump through than this for the IFRS. But we're not gonna get into it. But it is possible that it would be the same as for the IFRS. Okay. So determine the amount should have on carry piece on. Okay, so we're looking at this quick company, and here's their choices. I'm gonna break this out of here. So the revaluation is the higher of these two. Okay, so the higher of these two is the 52,000. So this is if they expect to use it, what would the net present value of the cash flows be? And this is if they just went out and sold it. And it's going to be the higher of those two. Okay. Oops. So if they use it, what's it worth? If they sell it, what can they get for it? The higher of those two. And the idea, but you know, you might say, well, why don't they just take what the market, what they can sell it for? Well, they might be using it in such a way that they can make more money on it by keeping it. So the present value of the cash flows or whichever is higher. Okay. Make all necessary journal entries on December 31st, year 4. Now, I'm going to assume that they did not make the journal entry for the depreciation year. If they already made the depreciation, then it would be a different entry. It would just be the second entry here. Okay. Okay, and then we would have impairment loss. He's 14 or something. Okay, impairment loss and equipment. So how much did they lose? The carry value is 60,000. So how much did they lose on this? Oh, come on, are you guys sleeping?
8,000.
Okay, so the loss, and again, we go back to the debits and credits, losses are debits. So the impairment loss would be 8,000. All right, now. This is where it goes to get a little bit tricky. So we wrote the equipment down by 8,000, so this is 92,000. So now the carry value is 52,000, which we would expect, right? I mean, that's what we want it to be down to. Yeah. How many more years are they going to use this thing?
6 more.
Yep. So what we have to do is take 52,000, and this isn't gonna come out clean, I don't think. Take 52,000 book value. And divide it by 6 years. This will be the new depreciation expense. That's not gonna come out nice. Should have found different numbers for doing this. Okay, so this would be 8,667. Say. When I make the test, I'll make these into better numbers. So this is the new depreciation expense per year. So going forward, this is what they're going to use for the depreciation expense. And by the way, this is for both of the international standards and for Gaap. And this is an important thing to know. When you revise, you make a revision either in the value, or let's say you made a revision in the number of years it's going to last, or the salvage value or something like that. At the point where you make the decision that it's gonna, that's either it's impaired or whatever, you stop at that point and go forward making the changes. You don't jump in the time machine and go back to when you bought it 4 years ago and put it on books for 92,000 and then go back forward and restate all your financial statements. You stop right where you found it, whether it's the life has changed or the value has changed, and then you go forward. So we're going to go forward for the next 6 years. With this adjustment we have. We did depreciation journal entries. Okay, I'm gonna get lazy. I'm not gonna get lazy. I've always been lazy. All right, so So 8,667. So going forward, we just make these same. Okay. I know what you're saying, hey, I hope this gets more complex. Hey, it does. We get to year 6. And year 6 is discover the technological innovations related to this equipment are not as effective as first expected. Oh, you know where this came, you know where some of this came about recently? Streaming services. Like 2 years ago, everybody was doing streaming, like everything was gonna be streaming. It was, there'd be 50 streaming, 100, whatever, streaming companies and channels and all that. Well, of course, they find out that it's not gonna go, people aren't gonna have 20 streaming channels and pay monthly fees. So anyway, all of these things that they thought were incredibly valuable now aren't. And so, they're having to reevaluate all these streaming channels that they've spent billions on, because they thought they were gonna be really, money makers, and it turns out they're not going to be, or they're not gonna be near as what they thought it was gonna be anyway. Okay. So year end, we come up with these numbers. So what we have to do now, yet again, find the carry value. Okay. So years 1 through 4, it was 40,000. Years 5 and 6, it was 8,000. That's not 8,667 times 2. $17,334. Okay. Get rid of my underline. So 34,666. Okay. So all of these are higher than our carry value. 44,000, 42,000. So this is the one that is, I was messing up my stuff. This is the one that is the higher of the two, right? Now, here's the thing though, we can't just write it up. We have to go back to the original and see what it would be worth, the original amount. We can't write it over the original amount. So it's so far away. If we didn't write it down, what would the carry value be? So I told you this one was going to be a pain. Here's the original impairment. If the original impairment didn't happen, what would it look like? Well, this would have been 100,000, this would have been by 6 years. This would have been 60,000. And this would have been 40,000. So we can't write it up to this, the 44. Because it would go over what we would have if we had not written it down in the first place. We can only go up to what we originally had. We can't go more than it, even if it is worth more than it. We can only go up to what we had in it. So we are going to use, so between these two, to do this without making it more confusing. Between these two, we pick the higher. But it can't go, this is sort of like the ceiling, it can't go above this. So it can't go above 40,000, so we're gonna write this up to 40,000. Okay, so. Yeah, I can. Okay, so how much are we going to write this up by? The most we can write it up to is what we originally would have at this time, which would be 40,000. What's the difference? You know, 5,000 something, 5,337 or something like that.
5,234.
Oh, okay. Yeah, you're right. Okay, so reversal of impairment loss. Oops, scratch that. The equipment's gonna be the debit. We're gonna write up the equipment by this. And reversal of impairment loss. This is sort of like a gain. And after all that, we would be right back where we were. You know, if you add 5,334 to this, you're gonna get the 40,000. There's 4 more years left. Divide by 10. And you'll be there. Okay, let me see if I can do this without screwing it up. Plus 5,334. That should equal 40,000. Hey. And years 7, 8, 9, 10, unless something else happens to this poor piece of equipment, it should be the same. You know, 10,000 a year. Go back to 10,000 a year. Any question on this stuff? That's longer than I planned on taking on that, to be honest with you. Well, I think what I will do is, where's my, there we go. I'm gonna send out the multiple choice questions. I think we'll just kind of go through them together. And I'll give you guys the extra credit points for them. Ah. Okay, so check your email if you would, see if those come through. Got some error messages. Hmm. Let's send it again. For whatever reason, sometimes Blackboard takes a little longer than usual to get stuff. Hmm. Have you guys gotten it yet or no?
I got it.
I got it as well.
Yeah, okay. How come I'm not getting it? All right, well, anyway. Not important. I got it here somewhere myself. So I think we'll go ahead and if you guys got it, we'll go ahead and we'll kind of go through these. And now usually what I would do is give you guys have you guys fill in the full thing. Kind of work on your own. Just because we're cutting close on time here, I think we'll just go through it. And there's only 3 of you guys, so definitely give you the credit also. So I think what we'll just do is go through them, and maybe we'll just do like the first 10, and some of these will actually end up on the exam. So. Okay. I think most of these we talked about, maybe some of them we haven't, but most of them we have. Which is generally the difference between US GAAP and international standards.
B.
Yep. Yeah, US seems to be more rule based. We would, we tell people, this every 5 years, 3 years, 30%, whatever it is, we're very rule oriented, and you'll have people doing accounting saying, well, can we do this? And yeah, basically the idea is if they don't tell you you can't do it, you can do it, which is not, international standards are a little more leeway, but also a little bit more responsibility. Okay, which of the following inventory valuation methods covering the United States GAAP is not allowed under international standards?
A.
Yeah, LIFO they don't like. Because, and the reason is that inventory does not flow like LIFO. It's a theoretical thing that we use in the United States. Okay, use the following information for I did not write this very well. Use the following, I adapted this, so that's why it's the following inventory. Just say use this to answer. Let's take out a few words here. There we go. Okay. So this is their historical cost. That's what they have it on the books for. And what would be the net realizable value? In other words, if they sold it, how much would they get out of it?
Would it be C?
Yep. Yep, these two here are gonna be used. So selling price minus net realizable value. And part of my reason for putting this one on is the second one on is so that just to kind of drive home that for both of these it's going to be the same. Now there is a difference between writing them back up. We don't allow for recovery of inventory. And two, you might wonder why don't we allow for recovery of inventory? Remember, inventory usually sells pretty quickly. So, well, at the end of the year, we might have, if there's inventory that is, impaired or obsolete or whatever, write it down. But it's probably going to be realized fairly quickly anyways. But international standards allow you to write it back up. So IFRS and GAAP both write down exactly the same now. Okay, under IFRS, what adjustment is made to inventory write down if the selling price subsequently increases? Any ideas which one?
Is it C?
It is C. Very good. Yeah, it is C. It should be reversed. Recovery of loss should be debited. This is kind of a tricky one. It should not be debited. A debit is, if it's a loss, it's a debit. If it's a gain, it should be credited. Hey, I have a wrong thing here. Well, it's still a wrong thing. Okay, here we go. So that should actually be credit. If that's a credited, then both those two would be right. Okay. Which of the following items should be included in the cost of property, plant, and equipment under international standards. I should probably just put IFRS. This one's also a little bit, it's similar to the US standard, but there's one little difference.
Would it be A?
Actually, A is, all of these actually are in there. So yes, A is, but the, all of them are in there, and this is, you know, A is, you go, okay, that's fine, B, yeah, okay, you pay taxes on it, whatever. This is the wacky one, the cost of removing the asset. You know, usually you take it, you have that residual value, you know, but they look at it differently. They say take that out right away, because that is really just gonna be a number that sits there and doesn't do anything. So if you want to get it just for the cost, you take that out beforehand. Different way of thinking. Not necessarily wrong, just a different way of thinking. Okay, in what way does IAS 16 differ from Gaap concerning fixed asset measurement subsequent to initial recognition?
Is it D?
The only thing, first of all, the first part is right. They allow for upward and downward. Gaap only allows for it to go downward. We're more negative. So if that's a downward, that would be right.
So then A?
Yeah, yeah. International standards allow for upward revaluation. We don't allow that under Gaap. And this is that might sound like kind of trivial, but remember, you know, some of these long-term assets, you may have a building you bought 40 years ago for $200,000, it's now worth 16 million. And so the $200,000, well, it's accurate that that's what they pay for it. You can go look at the records. It's a meaningless number. It's not relevant at all to today. So this is one of those big sticking points. This is why you can have a lot more assets on the books in using European standards, or actually I shouldn't say European, international standards, than you know, using US GAAP. And international standards, they say, oh, look, we're not saying it's more accurate, but it's more relevant. You know, that a 40-year-old number is not relevant. Okay. Company chooses the reevaluation method permitted in IAS for fixed asset measurement. A little tricky. Well, first of all, this first one is not true. You don't have to have an annual revaluation. You have to have a revaluation at reasonable periods of time. They don't tell you how long that is. It could be 1 year, it could be 5 years, whatever. Unless there's some innovation that changes things. You're not going to have a International Accounting Standards Board official perform the appraisal, because they get paid $2 or $3 million a year, and they're not going to run around phrasing things. The depreciated It's B, I think. Just update the valuation, so the balance sheet represents the fair value of the balance sheet date. Okay, so that's it. I don't know if that's a perfect answer, but it's better than any of the other ones. And we don't have the depreciated replacement cost is just no one does that. Okay. Blanco Chemical Company spent 15 million euros in development of efforts in creative fertilizers, which okay, so they got a patent. However, the expected distribution costs make it infeasible to market the chemical in the foreseeable future. According to IAS 38, intangible asset, how should the company record the 15 million? Now, one of the requirements for capitalizing development is that it must be feasible. So this, making into an asset, saying, okay, this is an asset, we're going to use this and make money on it in the future. And they're saying that it's infeasible. It's not gonna, they're not gonna do it, at least not now. So what would you do with that 15 million euros?
Is it C?
Now for Gaap, you would have to do C no matter what. We don't allow for development costs to be capitalized. International standards say that if it's feasible to come to market, that you can capitalize them. How does intangible assets differ from Gaap with respect to development costs? I'll give you a hint, it's not B or C.
Is it A?
Yep. Perfect. I didn't even get to cross out my ones yet. Okay, so yeah. Gaap does not allow for capitalization of development costs. You can't, no matter what. International standards allow for it, but only if it's feasible. So this one down here requires capitalization of all development costs. No. And we know that from here, that it can be an expense if it's not feasible. Okay, how does the definition of asset impairment differ between international and Gaap?
Is it all of the above? D.
It is. It's all of the above, and part of the reason is it's more likely that it'll be impaired. Man, this is a long problem. Because of this, the US standards, we have the undiscounted cash flows where they have the discounted cash flows. So it's possible that you'd have under Gaap something that is not impaired. Like let's say that the carry value was 55,000. Under Gaap, it wouldn't be impaired, whereas international standards it would. So it is more likely that international standards will have something to be impaired. Okay, what's the amount of impairment loss? Carrying value is 100,000. We can sell it for 85,000. Wait, we got minus the disposal cost. My company, I have no idea how to get a euro to pop up on the screen. What is that? 82,000. So we could sell it for that. Or the expected future cash flows. We're gonna take the higher of those two. Which isn't one of the answers. Oh, yeah, it is. What is the amount of the impairment loss? Oh, so what is the loss gonna be?
Okay.
Yep. Yeah, the loss is gonna be the 100,000 minus the 82. Well, this is gonna be the loss. So you're gonna compare these two, take the higher of them. So this one is higher. And this is one of the things that they don't allow for under the Gaap is this, that you could sell it. Under Gaap, they have different ways of evaluating. There's actually a 3-step process for figuring out what it is, but regardless. All right, under presentation, which of the following is not a definition of a current liability?
See?
Yeah, let's see here. Wait a minute. Yeah, the 18 months is. Oops. And what we're looking for is not a. I don't think we talked about this one. Under IAS 37, you don't even know that international standards, resources that are virtually certain to be received should be. This is one of this another kind of a strange thing, and this has to go with contingent liabilities. That if you are virtually certain to get it, some amount, you can actually put it on the books as an asset. Which, you know, in the United States, you don't count your chicken cells hatched until you get the court ruling or whatever it is you're looking at. You don't recognize it as asset. You know, the wording here, virtually certain. Is, you know, the wording they use. And I guess it would be like if there's preliminary stuff or something to go with. Okay. So some of those will end up on the test. And I should get the test out definitely by tomorrow. I'm gonna try to get it out tonight, but definitely by tomorrow. And I'm gonna leave you guys all +5 on it. For the extra credit. Which is what you can get, you know, if we done the choice question. So be looking for that, you'll have until I think it's the 30th. Is that what I said? Oops. Yeah, so you'll have until Friday the 30th to turn it in. Any questions? It'll be in your mailbox. They'll be sent out. They'll be in your mailbox. So it won't be in Blackboard. Because you may ask reasonably why, because there's gonna be different forms of it. So, yeah, and just turn in whatever form you get.
Will we be turning it in through Blackboard?
Yes, you'll be turning it in Blackboard, but it will come to you in your email. There will be a drop in it. Actually, I'll do it right now, so you don't forget. But yeah, so it'll be yeah, so there'll be a drop in Blackboard, and again, you can do it on notebook paper, you can do it on the handle itself, you can do it in the file itself, however you turn it in is fine. And it's unlimited, so you can take 10 pictures and turn them all in. But yeah, and the only thing about the test that's different than the handout is that once I get a grade on it, you can't turn it back in. You can always, you can replay, if I haven't graded it, then you can, replace it with a different, I want to do number 4 again. I think it should be this. But once I get a grade on it, then you can't turn it in again. Any questions? Okay. All right. Well, I'll be looking for that. It should be in your mailbox by tomorrow. Maybe tonight. I'll give it a shot tonight, see if I can get it in. But certainly by tomorrow. Any questions? Okay, and you guys get extra credit points there. All right. Well, have a good evening. I will see you.
Have a good night.